In this video, I'm going to show you how to make a successful investment in penny stocks. I'll cover how to find good investments and how to evaluate a possible opportunity when you find one. We'll look at what makes a good company and how to time your entry, as well as the most important of all, how to make a profitable exit. Along the way, we'll look at how to tell a real company from a fraud. Remember that all investing entails risk. Our job is to reduce that risk as low as possible, preferably to zero, and that does happen on occasion. Okay, let's get started. First, let me tell you a little something about penny stock pricing. The area between $0 and $1 is a real trash heap. There's a lot of junk in there, a lot of fraud, and it's a very difficult area to work in. But at the same time, you can't ignore it, because every once in a while you'll find a really high quality company that's down in the dumps, like American Airlines was when I found it at 38 cents. But it was a strong company, so it was a good opportunity. The area between $1 and $2 I'm pointing out because that area below $2 costs you a penalty of 1 cent per share in order to execute your trade. And that's because someone has to go in and manually enter the data and find somebody that was willing to take the opposite side of the trade. So if you're selling, they need to find a buyer. If you're buying, they need to find somebody that's willing to sell. If nobody's willing to sell or nobody has shares on the market maker has to take that. And I'll get into that at some other time. The area between $2 and $5 is what I call the sweet spot. If you can find things that are quality companies that show growth potential in that area, you've really got some fantastic growth potential. For example, if you find a stock at $5 and it doubles up to $10, you may double your money. But if you buy that same stock at $2 and it goes to $10, you've made 500%. So there's a lot of leverage in that area. Now, above $10, anybody's game. Another thing about the $5 level is that after a stock hits about $5, it comes to the attention of the funds, the analysts, and everybody starts looking at it then to see what's going to happen. So if you can get in slightly before that $5 sometime, you have a real advantage once other people start looking at it and the volume starts shooting up. Now let's go over to WillTheGeek.com and look for some penny stocks. The first thing I'm going to look for is growth stock. Now, growth stocks are not necessarily organized by how good quality they are, but they show signs that they're beginning to grow, or they show the biggest opportunity for growth. So let's start there. Now, what you'll come to is a page here that says this thing has two different strategies. I don't use the bottom one too much, but the top one will do. They're close enough. This one just picks stocks from all categories. This one takes them from small stocks, but I'll show you how you can arrange that so it doesn't matter. Now, what it's looking for is stocks that fit these criteria. What it's looking for is it has different factors like their low price to book value and a bunch of junk like that. They exhibit a trend of moving up recently. We're going to go in and just select the first criteria because it doesn't really matter. We'll just grab one. The reason it doesn't matter is because what we're looking for is not long-term investments. What we're looking for in penny stocks is to make a quick killing. We want to do it, however, without doing a lot of gambling. Once you click that button and you come over here, you get a list of stocks that meet growth criteria. At the moment, we're just looking at all companies at random, and I'm just going to pick a few. What we'll look for is this price here. So looking for penny stocks, we want anything under $5. So we have a number of them. 1, 2, 3, 4, 5, 6, 7, just on the first page. So this is a good place to start. Also, you'll notice this F-score. it's not a major criteria when you're looking for penny stock. It shows you at least you might as well pick the best quality companies. Also say something about prices. When you buy a stock like this one, China HGS, at $1.31, you're going to pay another 1 penny commission per share. When you buy a stock at $2 or above, you don't have to pay that extra penalty. So this one will cost you $5, for example, depending on who your agent is, plus a penny per share. So if you got 1,000 shares, you're going to pay an extra $10, so your commission is $15 instead of $5. So that's 300%. You've more than tripled your cost. So if you can, try to find the best quality stocks at $2 and above. Our target is to find something between $2 and $5. I wouldn't ignore these at $10 either, because these are already in a major play. In other words, anything below $10 is really a good bargain. Price of stock doesn't matter at all. If I see a really good stock and it's $100 and I know it's going to double, or at least my best guess is that it's going to double, I don't mind buying 10 shares of that, or even one, if that's all I can afford. If I have $100 and the stock is $100, I'll buy 1 share. You can do that. It's true that the $5 commission costs you some money, but that's okay. 1 share, if it doubles, you get $200. $5 return for $200, that's a pretty good ratio to me. So anyway, we'll keep that in mind. But let's start with this stock. I don't know what they do. Pretty obvious from the name. They're real estate business. Real estate in China. Here, let's have a look at what's happening. Now, I'm going to skip this top part because when you're doing penny stocks, it's not relevant. So I'll skip down to here and see what we're looking at. The top chart is the prices, price movement per day. And as you can see, this guy has shown some semblance of growth. This is the price movement across here. Down here is the volume movement. And you can see there's been a couple of big spikes. Now this stock has been selling roughly around $1.30 all the way along. All of a sudden it hit a big spike, volume shot up, prices jumped up, and as you can see there's one here where the high of the day was 448. Now what that means is that somebody saw this, they jumped in and they bought some shares at $4.48. And they paid $4.48 for what is essentially it's a $1.30. So call it a $1 stock and you paid $4 for it. You paid 300% too much. Absolute loser. There's no way that that person's going to get that money back. And I'll bet you that by the time the stock gets back down to $1.30, they're going to give up and sell out. So they lost money. You don't want to lose money. You're not here to lose money. The adage is, don't lose money. All right? So when you see a spike like this that really came out of nowhere, look at the volume in the preceding month. Almost nothing. Volume was, in some cases, nothing. 17,000, 15,000, 2,000, 34,000. It's very small compared to the, what do we have here? Almost 9 million. So what happened here? You have to ask yourself there, what happened here to cause this thing to jump up to 9 million shares traded? If you look at that at the average price of, let's say, $1.50 or even $2, you're talking about $15 million, $10 or $15 million worth of transactions done that day. So you have to kind of understand why, and I'll show you how to do that in a minute. Let's open another window and we'll go see. The name of this company is China HGS Real Estate, trading on the NASDAQ at HGSH. So I'm going to jump over to Yahoo Finance. HGSH. And what we're going to do, this gives us all the information that we have on that company. This is a summary. But what you can do is you can look down here and you can see if there's any news about that company. Who owns it? Is it a buy? Read all of these. They will tell you a lot about the business. So what you really want to do is you want to come over here to Profile. This is where we're going to start, is Profile. And you come down to Profile, and this tells you, of course, gives you a map of where it is. But this description, this is what you really want to look at here and see what it is they do. They develop real estate properties in the PRC. That can be a good deal. Okay, they're into residential apartments, parking lots, commercial properties, pretty much anything, it sounds like. Almost all of the real estate development in China is multi-level apartments. They don't have individual homes the way they do. There are a few, but not many. Here you've seen what they do. I would say that Chinese real estate has good growth opportunities. Now, in any company that you're looking to invest in or trade in, and just whether it's even for the short term, you want to make sure that they have a good opportunity to grow. They're a high-quality company, and they're undervalued if possible. Been around since 1995, and they're Hanzhong. I won't go into the financials because I'm going to do that on my side. This chart will give you a reflection of what we already know. Here's that big spike you saw over here, and now it's tapered off, and it's still doing pretty much nothing. At the moment, we haven't gone in. I'll leave it to you. Go ahead and read all of these items in the news and see if you can get a feel for what caused that big spike and what caused this one. Now let's jump back over to my site. Chart is a little easier to see. What you're going to look for here is, see the horizontal line I'm pointing to right across right now? That's the baseline for the value of this stock. And as you can see, toward the end over here on the right is beginning to kind of creep up. Let's hold that in mind and go down and look at something else. The second part of this chart, this thing down here, tells you a lot about how good the company is. The yellow bars, the yellow columns over here on the left show you the amount of sales they've got. And you can see that since 2016 up to now, roughly 2 full years, they've essentially grown. They have their ups and downs, but essentially they've grown. So if you look from December of 2016 to December of 2017, that's a growth period. You can also see that from September to December, it fell off. From September to December, fell off again. That's probably a seasonal happening. It probably happens every year like that, so I wouldn't worry too much about it. The green columns down below are the profit. Also, we want to look at this. We want to look at 318 back to 317, and you can see that we have a constant year-over-year growth. That's good. That's in the plus column. That's why this company ranks fairly high. What did we say? It has an F score of 7, which is pretty good. Anything with 7 and up is good F score. Now we want to look over on the right-hand side here, and we're going to look at the red. The red is how much cash they have on hand, and the purple is how much debt. Now, certain kinds of companies, and real estate is one of them, have huge amounts of debt. It's normal. It's not an overly big concern unless the debt is growing and the cash and if the revenue is going down and the debt is going up, that's a really, really bad sign. They've managed to control their debt since last year, where they hit their peak, and they've pulled it down every quarter a little bit, which is good. That means that they're paying off their debt. At the same time, they've not sacrificed their cash. They still have $6.5 million in cash, $3 million increase. So that's also good. So this company is not a bad choice. Let's go down and look at the metrics a little bit, see what they tell us. The PE ratio at 26 is high for the group. Notice something about these dials. The white part all the way around is everybody. The green part is this real estate group. They're high even for the real estate group, but not overly so. I would prefer to see it down here in the middle. On each of these dials, the center line here
is the medium. That's halfway between the low and the high. In the low half is usually good. In the high half is usually not so good. But still, the PE ratio is not a very good gauge of how good a company is. I put it here because everybody uses it. That's about it. In the real estate business, you'll probably want to look at price to book. And this is also true of banks, insurance companies, real estate companies. They all fall into the same group, and you should pay more attention to price to book. Price to book in this case is rock bottom. So really they're in good shape for their industry. The EPS, a little higher than average, which is cool. That's fine, 5 cents a share. It depends on what they're doing with it, but not bad. Price to sales, they've got good sales and a low price on their stock. So this is not a bad company. They run gross margins of around 17%. That's also, for the real estate business, that's pretty good. I've seen better in other industries. You see sometimes 100%, but that seems strange, but you can do that. In the last 3 months, their price gain has gone up almost 20%. Again, not bad. Now, the bottom line question is, as a penny stock, would I buy this company? Today, right now, no. Would I throw it away? Also no. What I would do with this is I would take and keep an eye on this company because of this upswing and see if it continues to climb. If they get a close, let's see, their current close is about $1.60. If they close above $2, I might swing in there and buy it. You notice that I'm not concerned with buying the absolute bottom price. What I am concerned with is buying the potential for growth in that price. If I pay $1.50 for it now and it goes tank, I lose $1.50. If I wait until I'm pretty sure that it's got a really good chance of taking off and do it at $2, fine. I haven't lost anything, I've gained. That's how I would play this one. I would take this stock and I would go up here to this, add to my watch list. Now I'm going to do a whole segment on the watch list and how important it is. For right now, just believe me, it's really very, very important. To use the watch list, you'll need to have an account. You'll have to go register if you haven't already. For right now, we've taken one stock and I've given you a pretty good, a little bit in-depth analysis of how this company fares. So let's go see what else we can find. That's just our first one. You'll want to go through every one of these things. Don't be afraid to just pick up something like, maybe this one is a $6 stock, but maybe it's a much better deal than the other one. Let's see what happens. If they don't have good financials, we'll get an error. It takes a while because we're pulling in a lot of data, a whole lot of data. Okay. So this one's C-SPAN Corporation. I don't know what they do either, but let's repeat our process. SSW, New York Stock Exchange. So let's go over here and repeat our previous. And we see the chart that we've had before. Now this chart, you can see they're growing. Their stock price is moving up. They have essentially gone from a low of $5.50 to a high of $10.72. Well, that's almost a double right there. See what can happen with these stocks. And it's off a little bit right now at close at 923.24, 924. Still, it's a good move. Probably this is because I won't go into too much technical stuff. Right around here, it should begin to move back up if it's still a strong stock. Look down here and you can check their news, read all their news, see what they do, see what they're good for. They look like they're in the shipping business, yes? Well, let's go look at their profile and tell for sure. Profile, right here. What does their profile say? Based out of Hong Kong. Hong Kong's an energetic environment. I've been there many times, and I like Hong Kong. Okay, they're an independent charter owner. They own container ships. Okay, this is pretty good. You see, they're under long-term contracts and they're fixed rate. You like that because that means that they have fixed income for a period of time. Gives them time for when they know they're going to make a certain amount of money for a long period of time, they can allocate their resources, plan their growth, plan their buying, and so forth. The downside of this company probably be that the container business would be maybe competitive, maybe limited in size. On the other hand, if they're a smart company and they do what they do really well and they save their money, they probably have a good chance of taking over some other company. So let's go back and look at their financials and see what we see. As you can see in the revenue, the amount of money they make is fairly steady, not a lot of ups and downs. This has to do with their long-term contracts. Again, looking at the past year compared to this year, we're over 224 million. Last year we were 201 million, so we're up $20 million or so in revenue. The important thing, though, from there is look how they've increased their profits. That's nice. Again, container ships, debt, they're going to have a lot of debt because they own ships. Any company like airlines or real estate, shipping, railroad, they have a lot of debt because they have to buy ships or trains or buildings or whatever it is that they buy. How they manage that debt is important. This is a little bit worrisome. Here their debt was going down, and here it's swinging back up. Depending on what you go over there and read on the news, this may be a logical thing for them. Maybe they're in expansion mode, so they've increased their debt accordingly. Maybe they just bought a new bunch of ships. That would mean in the next few quarters, they will have better revenues. You have to think about these things and trade them off. Now down here, you'll see that they're pretty much the only one in the business. It's a very narrow market, I know that. So you won't see needles showing up here, but you do get the data for the latest quarter. You see that their PE ratio at 1805, hard to say, it's all 1805. Price to book at 0.42. That's probably a pretty good ratio. Difficult to tell, but their EPS, or earnings per share, is 37 cents. Remember, the last one we looked at was 5 cents. So these guys, they got a pretty good amount of profit in their business, where the other one had lower profit, but those are trade-offs you make. Okay. You see what I'm doing? I'm looking for a stock that will probably do us some good growth potential. Would I buy this stock? No, I wouldn't. But it's a good exercise to review.
By now you've gotten a pretty good introduction to penny stocks and how to find them. We've looked at a couple of examples. We've learned the three elements of successful penny stock investing: quality, growth, and value. We've learned the four features of a quality company: rising sales, rising profit, rising cash, and falling, or better still, no debt. Now, it's taken me a lot longer to explain all of this than it takes to actually do it. With a little practice, you should be able to do it for a couple of seconds for a bad company and a minute or two for a good company. It's really a very simple process. We're also going to take a look at the difference between a good quality penny stock and a fraud. Okay, let's get on with it. What you're looking at here is the daily price charts for American Airlines in January of 2018. Now, what I want you to notice is these 4 days right here. Starting on the 14th of January, there was a big surge upward. You can see it there. On the 15th, it made another big surge, but look closely at the volume down below. You'll see that there was a drop in volume even though the price went up. So that's a warning sign right there. On the 16th, there was a reversal. It went up again. It opened above the high of the previous day. It flipped over and couldn't sustain the move, and it fell back. It fell back on somewhat lower volume, but it fell back. That is what is known as a key reversal, and it's about 80% accurate. So when I saw that happen, I knew it was time to close out my final position with American Airlines, and I did so by selling out on the 17th the following day. I had made prior sales as the price went up and down, but this one, when I saw the key reversal, I knew it would never be back. That's when I sold out. And that's a very reliable signal. If you watch your stocks and you see that kind of price pattern, it's probably a good time to get out and at least sit on the sideline until you can see what happens. Now in this next shot, you can see exactly what did happen. The red arrow marks the point where I made my exit. And it's very obvious what happened after that. So you can see that the key reversal is really a pretty good pattern, and it's a good time to mark an exit. Now let's have a look at what it takes to tell a good company from a bad one. We're doing investing in order to make money. We're not there to throw it away, and we're not there to gamble. So we want to use the same criteria for a penny stock that we use for any other company. We want to look for quality, we want to look for growth opportunity, and we want to look at good value. So let's take a look at a couple of companies here for samples. The first will be Harris Exploration that I want to take a look at. You can see that Harris is trading on the open market under the over-the-counter stocks, 0.0026 cents per share. That's 1/4 of a penny a share or so. Now the problem is Harris Exploration an active company? Are they making a profit? Do they meet the three criteria that we're looking for? Quality, growth, and value. When we look at Harris, we see absolutely no financials shown. So let's check the SEC and see if they have any information. At the SEC, you can see the link below. You can enter the name of the company or its ticker symbol and see what information they have available. Trying the name first showed nothing. Trying the ticker also shows nothing. So Harris Exploration is really not in business. Even though the stock is shown on Yahoo, and yes, you can go out and buy it, you don't want to. If they don't have valid financials, they're not making any money, they're not doing anything, all they'll be doing is taking your money. The next company we want to take a look at is called Hydrogen Hybrid Technologies. They're in the business, supposedly, of building cars and trucks using hydrogen technology. So again, we're going to repeat our same process. First of all, let's look at the summary and see if there's any news. Nothing. So let's go take a look at the financials, see if they've been filing financials. Now in this case, we do see that they have financials. Obviously, if they have no financials for the last 8 or 10 years, then it's probably not something that you want to invest in either. But just for fun, let's go over to the SEC and have a look and see what they have to say about Hydrogen Hybrid Technologies. Let's copy the name. And paste it in. Do our search. And indeed, we get a list of documents. Last time we got something that said no documentation at all. They had no record. On this one, you can see the summary of the company at the top and a list of documents and most recent filings. And again, you'll see that the latest thing was about 2008. And we want to see when was the last quarterly report. The quarterly report is the 10Q, and you can see it here. And that was filed in 2008 in February. They're far out of date. They have nothing to offer you. You'd be wasting your time and money even considering this. So whenever you find your penny stock advisory or some penny stock cheat sheet or whatever they want to call it, give it this quick checkout. Take a look at the SEC or just take a look at Yahoo. If they don't have up-to-date financials, if they don't have news, and if they don't have some possibility of growth, don't bother with them. Okay, well that about wraps it up for now. I hope you've enjoyed watching this video as much as I have enjoyed making it. If you have any questions or suggestions, please let me know. You can use the contact form over at willthegeek.com to get in touch. If you have some sort of special subject that you'd like to see a tutorial on, let me know that too. I'll be glad to make one. In the meantime, I hope that I can help everybody become a successful investor. It would be great if you could share your success stories with me. Also, maybe the ones that weren't so successful. We can take a look at them and see if we can analyze and figure out what went wrong. This is Will the Geek. Thank you for watching. Good day.